Well, welcome everyone to the latest IC Companies and Markets podcast. I'm Mark Robinson, standing in for Dan Jones, who's abroad somewhere. But happily, I'm joined in the studio by my colleagues Aaron Withy, Valeria Martinez, and Hugh Moorhead. Uh, we're going to be discussing a range of topics today. Hugh will be looking at the Q3 updates for the UK banks, and Valeria and Aaron will be looking at a couple of selections from our AIM 100, the first tranche of which is due out in this week's issue. As everyone would have noticed by now, the evenings are drawing in, but for any of our listeners who followed the axiom to walk away in May, they get the chance shortly to get back into the market in November. Unfortunately, they'll be faced by the government's autumn budget as well. So sentiment might be weighed down a little by that. Presumably, plenty of the readers never went away in the first place, given that the FTSE 100 has hit successive highs in the subsequent period. I was looking at the metrics earlier on today, and the sort of discount hasn't really narrowed between the FTSE 100 and its US comparator over the period. The FTSE is now trading at just under 20 times earnings, whereas the S&P 500 is at a multiple of 28.8. As I say, that discount hasn't really narrowed over the period, which is slightly disappointing in a sense. But of course, once you remove the sort of large tech stocks from the US index, then those multiples start to coalesce to a certain degree. At any rate, if you look at the average dividend yields as well, you get an idea of one of the other differences between the markets. The FTSE's yield at the moment is 3.2%. That's gone down appreciably, obviously, over the last year or so. Whereas the S&P yield is just over 1%. So that describes really in a nutshell the difference between the two markets themselves. In one of my recent musings, I suggested that a blended mix of US growth and UK value stocks might be a worthwhile approach for anyone that's looking to start investing in risk assets. That's one to tell your grandchildren, really. Moving on to some of this week's prominent news stories, NVIDIA, specialist chip maker, became the first company to hit a market capitalization of $5 trillion. It's amazing, really, but sentiment towards the stock has been buoyed by the order backlog there, amounts to about 500 billion in AI chip orders. And also there's plans afoot to build 7 supercomputers for the US government there. It's interesting, really, because it's been about 6 years now since Apple became the first trillion-dollar company, and it's now worth about $4 trillion, the same valuation really for Microsoft as well. So it's hardly surprising in a way that the fears over the stock market bubble have been growing. However, we've had a wave of big tech earnings reports over the last couple of days, the Q3s from the US, and they've been generally quite favorable, particularly with the take-up of cloud technology as well. Meta had to take a $16 billion tax hit, and their earnings missed by a wide margin there. That was probably the least favorable of the three, whereas Alphabet topped $100 billion quarterly revenue for the first time, with cloud revenues up there by a third. It was a pretty similar story where Microsoft was concerned. Their Azure cloud revenues were up by about 40% as well. So we're going to continue to hear stories about a potential bubble. I mean, we covered this a little bit in last week's podcast as well, so I won't bore everyone to death with the differences. The one thing I would say, though, is when you look back to what happened in the turn of the millennium there, a lot of the companies that were being pushed through had neither revenues nor cash flows, and they were funded really to a significant degree by debt for equity swaps as well. Of course, this time around, it's not the case. These type of companies who are some of the biggest investors in AI technology, they just throw off cash like it's going out of fashion. So whilst there's obviously some risk given the elevated valuations, I would say it's not a like-for-like comparison. Now, elsewhere, a spat brewing between China and the Netherlands, apparently, over Chinese microchips, and that threatens to potentially shut down the European car industry. I mean, the car industry itself has had one challenge or hurdle after another over the last 5 years as well, and this is just the latest to hit it there. We got another reminder as well about how discretionary budgets have been stretched to the nth degree as Gordon Ramsay's restaurant chain has slashed jobs across the board there, no doubt in tandem with a foul-mouthed tirade. Also, gambling stocks have actually been tumbling as well on further budget speculation. Erin, I believe you looked at that this week.
Yeah, definitely. I think the key kind of UK listed players in the gambling stock world have all suffered quite steep share price declines off the back of speculation that Rachel Reeves is going to usher in a bit of a tax raid on the sector, particularly those with quite high revenue exposure to the UK or revenue exposure to in-person venues because of concerns around machine games duties going up. And there's been a lot of input from across the spectrum here, not just the Treasury's own consultation, but the likes of Gordon Brown has weighed in promoting higher levies. So it's definitely getting a lot of media attention at the moment. And I think it's really affecting sentiment.
Yeah, it won't be the only corner of the economy as well that's under the pump in the upcoming autumn statement. So we'll keep an eye on that. The government has actually slashed some of its forecasts for the amount of electricity it now expects to generate from wind power, offshore wind power. That's a bit of a blow for Ed Miliband's net zero plans. I was to recall the expression tilting at windmills, as that readily sprung to mind then as well. But I don't know who's playing Sancho Panza to Ed Miliband's Don Quixote, presumably Gromit. Hopefully, this is an indication that the government has started to recognize the correlation between energy prices and GDP. There's probably heightened tensions this last week as well after Petrofac's decision to place its holding company into administration. So the government's North Sea policies are still under the microscope there, and it's to be hoped that they take a little bit more of a pragmatic attitude on the energy front there. Also, there was a lot of noise this week in relation to private credit. There's a little bit of a building anxieties over, the general threat to the wider economy. There was some of the main private credit bosses from the likes of Apollo and Blackstone appeared or made submissions to the House of Lords Committee this week. And in basic terms, they played down the fears that have been recently raised by the IMF and the Bank of England. And earlier on this week, actually, Fitch Ratings also joined the chorus too. The representatives think that the sector is actually safer and offers more stability to the financial system than traditional regulated banks, which seems a little bit counterintuitive, but they say that there's less risk of contagion because private credit's funded through institutional investors, pension funds and insurers, rather than being backed by consumer deposits. I think that's an overly simplistic description of their submission as well. But actually, as we're talking about shadow banking now, it's worthwhile bringing in Hugh to talk about his banking review this week, which was generally Q3s and in relation to the UK banks itself. So, Hugh, just to how vulnerable do you think UK banks are to private credit lending?
So the key, I guess one of the key headlines to have come out of UK banks' results last week was Barclays taking a 110 million provision for their exposure to Tricolour, which is one of the two kind of headline sort of shadow banking funded defaults that's happened in the US in the last few weeks. It's worth saying that the sort of lending to private credit in the UK is in a far more nascent stage than it is in the US. Barclays is probably, of the UK listed banks, certainly the domestic focused ones, has the largest exposure to private credit. It's about 20 billion. So that's about 6% of its total loan book. Of that, about 2/3 is lending in the US, with the remaining third in the UK and Europe. They sort of management uttered some platitudes about increased vigilance and sort of improved, tighter financial controls around their lending during the Q3 conference call, but it remains to be seen. Ultimately, it is a risky area, and if they continue lending there, then there may well be more provisions to follow. Lloyds and NatWest, on the other hand, didn't really discuss private credit during their reports last week, but that's perhaps unsurprising. They have pretty small / minimal investment banking footprints, so their exposures are likely to be a lot smaller.
Yeah, without a doubt. I mean, it was interesting, your piece as well, because I did note too that there were some upgrades there, which is interesting given that Rachel Reeves may be looking at the implementation of another levy this time around.
Yes, so all three banks, each of Lloyds, Barclays and NatWest upgraded their 2025 returns guidance this week, or last week rather. So that was reassuring to see. It's worth noting that guidance excludes provisions relating to private credit or motor finance as well, for which Lloyds and Barclays both recognised a provision. What is looking positive for the banks? Well, firstly, at the top line, they're seeing some decent loan growth. Loans have grown at about 4% year to date, so that's pretty good. Mortgages and also credit card lending have generally been driving this, which is reassuring to see. Although on the credit card point, increased credit card lending can also come with an increased risk of loan loss provisions, depending on the health of the consumer. The other benefit they're getting is from the shape of the rate curve. So obviously with a steeper rate curve, with the long end being steeper than the short end, that benefits banks who tend to borrow short and then long. So they take in deposits from customers that are either have sort of zero duration because they're current account deposits that can be withdrawn immediately, or they might be term deposits with a 1 or 2 year duration. And then the loans that they're lending out, well, mortgages, for example, those are going to be on 2 or 5 year fixes predominantly. So that's helping them out a little bit as well. Some of the other benefits they're seeing we're seeing some efficiency savings still come through a little bit better than expected at NatWest and Barclays. And also Lloyds said that their sort of loan loss provisions that they incur this year are likely to be a bit lower than expected because of benign credit performance.
You mentioned as well that the mortgage market there has held up better than a general look at the financial pages would have us believe there. And in fact, it looks like it grew in the year through to August. This is another point which seems somewhat counterintuitive if you look at press coverage of the mortgage market at the moment. How do you see that going forward?
So yes, the mortgage market has definitely been better than sort of wider economic growth. In terms of what we've seen so far, the market's up about 3% over the last year, which is okay. It's not gangbusters, but it's pretty healthy. We're probably seeing more of that volume growth from remortgaging rather than first-time buyers hitting the market. What's positive is that we are seeing a high level of mortgage approvals. So I think September numbers were out the other day, and they were the highest for about 9 months. So that's good to see. What it means effectively is that while people may not be transacting and buying houses at the moment, potentially because of budget uncertainty, they are at least getting the mortgage approvals that will enable them to do so once there's maybe a bit more clarity around the issues like property taxes going forward. In terms of what else we should expect to see, pricing is very competitive, which is good for the consumer, might be a bit less good for the banks. And although we've seen a bit of volatility in pricing ahead of the budget, the general trend there is going downwards, and swap rates have declined recently, which is generally a good indicator that perhaps once the banks are a bit more confident about the direction of UK fiscal policy, we may see prices drift down again off in December.
I guess one point worth making as well is that the government themselves would be loath to stymie first-time home buyers as well. So that end of the market actually might hold up volumes going forward there. I guess when you look at it now, do the banks' valuations, do they reflect their ability to generate excess returns at this point? And do you think simply because of this that Rachel Reeves might look at some form of a levy on the sector itself?
I think profitability has surged in the last couple of years, helped by rising interest rates, but also the banks just generally getting their houses in order. What this means is that they are now probably amongst what is a pretty barren orchard, some attractive low-hanging fruits when it comes to raising treasury revenues in the autumn. We don't quite know how big any surplus tax increase will be. The banks already pay a 3% corporation tax surcharge, so the scope for that to increase further, maybe to 5%. Bank management teams have been, I would say, reasonably accommodating of this. Obviously, they don't want it, but I think they're sort of slightly resigned to their fate. In terms of valuation, though, the story is generally still pretty positive. Share prices have risen for the three that we've touched on by 60% over the last year, which is pretty strong. But there may be further to go in some instances. I mean, all three consensus is baking in double-digit EPS growth for all three banks, and that EPS growth gets as high as 20% for Barclays. That's only on 7.5 times 2026 PE at the moment. It trades at book value, so the value of shareholders' equity, which is a little bit cheaper than Lloyd's and NatWest. And with management signalling that they will look to raise profitability targets at full year results in February, there may be scope for continued strong performance from Barclays here. Although it is worth noting that their investment banking arm means that you will occasionally get provisions like Tricolor, and that a bank like Lloyd's or NatWest might be a safer bet if you're looking for, I guess, less risk-averse returns.
Yeah, well, it doesn't sound overly stretched for sure. Before we move on to the AIM 100 coverage as well, one of the companies that you were looking at was Arbuthnot Banking too. So if you could just give us a quick rundown on what you've found out about them.
Yes, so Arbuthnot is far smaller than the large UK lenders that we've discussed. What the bank's business model is essentially, it takes its cheaply funded deposits from its private banking arm and from some of its commercial banking customers, and it lends them out in specialist finance businesses like truck leasing, for example, and it's able to make a bit of a spread that way. Those specialist financing businesses might be areas that some of the large banks are more reluctant to enter into. I think what's probably unusual about Arbuthnot is that it's 58% owned by its chair and CEO, who is an 85-year-old called Sir Henry Angest. As far as I'm aware, there's no signs of him stepping back. But yes, I guess shareholders are essentially beholden to his decision-making, which is obviously up to them. I think the business model seems pretty sensible. They certainly seem to have a sensible approach in terms of managing risk. They've not let their loan book grow this year because they see pricing as uncompetitive in some of their lending areas. And the bank's returns are decent. They've hit their 15% pre-tax return on equity target in the last couple of years. And trading on 7 times PE is a bit cheaper, not only than the large listed banks, but also relative to some of the other specialist lenders like OSB and Paragon Bank. I think probably the risks there, though, are that apart from the sort of key man risk around the CEO, are also that loan growth for them is slowing, whereas it's picking up for the large lenders, as we've discussed. But also they're possibly a little bit more vulnerable to falling interest rates because they don't have some of the levers in place that the large banks do to mitigate those effects, like structural hedges, for instance.
One imagines that their loan book is slightly different, well, slightly more tailored affair as well. But it's a famous city name as well, Arbuthnot. So, Hugh, thank you very much for that rundown there. We'll get on to a couple of these companies now from the other companies from our AIM 100 view as well. Aaron, you've been looking at Kitwave, which, according to my notes here, is a wholesale business with deposits and delivery through the UK. Could you expand a little bit on that, please?